Welcome back everyone to the Audacious Money Witch channel, where we talk about investing and trading and a lot of fun things. My pretty rose. It's good to be back. I was on the road traveling from Tofino to Cabot Trail. I am not going to let you wait too long for a market update. This video has to be made. I think there is a reason why they are selling down a lot of these stocks. I will mention in this video. There is a reason why gold and silver prices are down. There have been enough signals flashing right now, so I will let you know why I believe a flash crash is likely to happen, when it might be happening, and what I'm going to do in the meantime. Am I going to sell my entire portfolio? Going to cash, collect 5% in T-bill and wait? Or just buy the dips? I will explain it all right after this. The epic crash, which took place on the 19th of October 1987, also called Black Monday, currently holds a record in terms of daily percentage losses for the Dow Jones Industrial Average. For example, fell by 22.6% in just one day. Definitely the largest one-day percentage drop by far in the United States. Why am I talking about this? Well, there is a great reason for this. Let's head over to Bloomberg, where we start today's story out with the headline is U.S. jobless claims rise to the highest in 9 months, now led by California, and perhaps having something to do with a $20 minimum wage increase. But check this out, initial claims increased by 13,000 to 242,000 in the week ending June 8th. This according to the Labor Department. The U.S. unemployment rate rose to 4% last month, reaching the highest level for the first time in more than 2 years. And most are reflecting people returning to the workforce and not finding a job. Layoffs, however, have remained subdued. And part of that reason has to do with the fact that many people who are losing their white-collar jobs are getting severance packages, and they don't show up in the initial claims report. And one of the issues we brought up is how initial claims are consistently right around 212,000, yet another data suggests the numbers should be much higher. Well, now it's starting to move up. And as you can see, it does have something to do with inflation. As we look at the Consumer Price Index, you're shown on a year-over-year rate change in blue. And many believe this has something to do with people entering the workforce and not finding work, but also has to do with the fact there are people on unemployment who can't find work. And you can see during periods of high and rising inflation, what happens is households can't keep up with this. So what happens then is one working household now becomes two people working as they try to keep up with inflation. And we're seeing that effect a little bit now, but that's not the real issue here. New claims before adjustment for seasonal influences rose by 38,530 to 234,707 last week, and besides California, Pennsylvania, and Minnesota all saw sizable gains, and of course the 4-week moving average rose as well. Here's one of the issues we're getting to. Federal Reserve Chair Jerome Powell on Wednesday said the labor market remains strong, but gradually cooling with supply and demand coming into better balance. Is it really strong? But gradual cooling with supply and demand coming into better balance, this is something the bond market disagrees with. This is something I need you to understand. The Consumer Price Index has a lot to do with the labor market, because when people get on unemployment, of course, their checks go down, and when their checks drop and they're in periods where high inflation and high interest rates mean high debt service costs, their discretionary spending drops. Now, this doesn't hit the economy immediately, but with a lag, it starts to as they cut back on their spending. And you can see here that as continued unemployment claims rise, is coming back in the late 80s. What happened? Inflation did rise, and then it came crumbling down as demand eventually started to fall apart. And that meant, of course, consumer prices fell as well. You can see that relationship again going on in the dot-com bubble, the financial crisis, and even now as the continued claims remain near relative historic lows. The issue here is we came from an overheated economy, and you can look at the peak of inflation and you could see that it matched the bottom in continued unemployment claims. Now these are looking to move higher, and that is dangerous but fantastic for the bond market, because Gen AI is not only taking over the stock market, it's also taking over white-collar jobs. Why pay a salary of $70,000 a year as a management consultant when you can subscribe to AI as a service for a fraction of the cost? So why are people getting on the unemployment line? Well, it's because there isn't that big of demand for labor due to Gen AI, as the leaders are suggesting. So as we see demand fall, what employers do is they start to cut hours, they start to cut back on wage growth. That means, of course, decreasing in compensation, shown in blue, on a year-over-year rate of change. And you can see these decelerations. They tend to match periods, particularly heading into a recession, where you see people get on unemployment and they stay on unemployment because there's a lack of jobs for them. Make this even worse, these decelerations tend to lead to rising unemployment claims, and that is dangerous because we see here now continuing claims have broken over 1.8 million, now standing at 1.82 million for the week ending June 1st. And of course, the article notes from Bloomberg. So that's the reason why TLT is totally breaking out from this big wedge forming. Started from the bottom of last October to the April low this year. You can see TLT has broken out of the downward sloping trend line, breaking above the 50 and 200-day moving average. Its MACD is actually looking constructive, pointing up, signaling the trend is going higher. As both ECB and Bank of Canada cut their first rate and released their dopamine-stimulating fuel, as Taylor Swift's record-shattering Eras tour is continuing to supercharge consumer spending as it enters its UK leg, suggesting the Bank of England may not be out of the woods yet in its fight against inflation. As hundreds of thousands of dedicated Swifties flocked to London in August to see the singing sensation during her final UK dates, the economic boost could be enough to defer a possible September interest rate cut. I guess Taylor Swift provides more dopamine than 25 basis points. Wow! Are you ready for it? Anyways, higher for longer is due for a break, as we see a lot of stock crashing heavily as TLT heading up silently. First, we are seeing small caps getting sold off first. Like my Honest and True Leaf stocks, they look cheap, but could get cheaper if we crash. Even Lulu and Nike are soft in their sales growth. This suggests consumers are getting weaker, while the enterprises with big cash piles are loving this. That's why they invest their extra cash into AI chips to power new AI phones, laptops, and maybe TVs. Roku is stuck for another reason though. So how is the market crash going to happen? Well, now that most central banks have confirmed that interest rates has peaked, that means bond yield has peaked. As we are going into the cutting cycle, we tend to see the market crash follow. Looking at S&P 500, we are already up close to 15% year to date, and it's only in June. If we don't have a correction, that would be an unreal market. Because stock markets usually only go up 10% on average. So what am I doing at the moment? I am interested in taking profits on my art of trading portfolio, like my silver stock, because as the recession crash happens, it will take the price of gold, silver, and Bitcoin down with it. Especially for gold and silver mining stocks. These are stocks that follow the S&P 500 generally. The first important warning signal danger in the stock market was one, the fact that we have the Hindenburg omen, which is a split unhealthy market, which is what we have now. And the Fantastic Four are up, and the rest of the stocks are down. And the Titanic syndrome, powerful danger signals on the stock markets. There are internal weaknesses, major weaknesses in the stock market that usually come before a major drop or a correction in the stock market. In fact, the previous times when these signals occurred, the stock market has usually dropped by at least 10%, sometimes by 20%, or more. In fact, when these signals occurred in the year 1987, 2007, and in the year 1999. That was right before a major top in the stock markets for gold, silver, and Bitcoin, and small cap stocks. I am going to buy the dip when the S&P 500 crash happens. For now, I am going to take my profit and run. All this is not financial advice. It's your money. It's your responsibility. Like Spider-Man said, great power comes with great responsibility. I am just showing you all what I am doing purely for educational purposes only. Let me know in the comment section below what you are going to do. Do you think the storm is coming and the market is going to crash? And thank you for watching.